This is Ken Boyd. This is Advanced Accounting Part 1, Labor, Material, and Sales Variance. This is the first portion of our continuing education course on Advanced Accounting Part 1. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our email, our phone number, and we're on Facebook at St. Louis Test Prep on Facebook. This is a series of problems that a student of mine was assigned, and they all deal with advanced accounting concepts. The first one's a little easier than the others. It talks about planning production in a manufacturing environment. And a company has sales that they anticipate by month. It says in the first line, Coleman anticipates sales of 50,000 units, 48,000, and 51,000 in July, August, September. So we've got the months across the top of the chart, and we have sales under each one of the months. Company policy is to maintain an ending finished goods inventory, and backing up for a minute, finished goods are those goods that are completed, boxed up, and ready for sale. That's what finished goods means. The company's policy is to maintain ending finished goods inventory equal to 40% of the following month's sales. So if somebody walks in on the first day of August and wants to place a big order, you have enough ending inventory based on your estimates to fill that order. On the basis of this information, how many units would the company plan to produce in August? So the month that's being asked about in the question is August. Well, we have to roll forward from July to get to the information that we're going to need in the August column. The 48,000, the sales for August, is given in the question. The ending inventory takes some computing, however. What we're asked to do as an estimate is include 40% of the next month's sales, which is the 51,000 in September, as ending inventory in August. If it's ending inventory in August, that means we need to produce in August not only the stuff we're going to sell in August, but also the extra inventory we need at the end of the month. So if I add those two up, we get 68,400 production for the month of August. You'll see larger questions on this topic in cost accounting where not only do you plan sales and production, but you also plan accounts receivable, how much cash you'll need, and expenses as well. Those are larger questions that we'll do in a later presentation. Now we switch over and we start talking about the bulk of what's on this video, which is variances. I'm going to make this text a little bit larger. Labor rate and labor efficiency. Now let's talk about this for a minute. Variances come out of the idea that we're going to have a budget that we plan on, and then we're going to have actual results. And you'll notice that the way all these charts are set up is that the actual activity, actual hours, actual price, in this case, is at the far left. Standards, what you plan on, what you budget for, are at the far right, standard hours, standard price. You'll notice as we go through, that's the way all the charts are going to be set up. Actuals on the far left, your budgeted or standard is on the far right. We have some activity in the middle that is a blend of actual and standard. Labor rate means that the rate, the hourly rate that you're paying employees, is higher or lower than what you plan. Efficiency means that the number of hours the employees worked is higher or lower than what you plan. So let's use that as a basis. Alex Company recently completed 10,600 units of a single product. It's single product. That's how many units they made. It took 32,000 labor hours, and it cost the firm $480,000. So based on that first line, we can start filling in the chart. 32,000 is actual labor hours. $480,000 is the actual cost for the labor. So the 32,000 and the 480 are given. And if I take the total cost of 480 divided by the 32, I put plug figure here because I get an actual rate of pay, an hourly rate of $15 per hour. So now I have all the information in my actual column. Let's read on. According to manufacturing specifications, each unit should have required, should have meaning what we planned, 3 hours of labor at $15.40 an hour. Now this is where people get tripped up. The sentence says for each unit there's a certain number of hours of labor time, but note in the sentence above that we produce 10,600 units. So consider 10,600 times 3 hours, and now we're getting at what we planned in terms of labor time. This is the rate that we planned. So we can plug in that rate per hour, $15.40, as a standard price, but we need to do a little more work to figure out standard hours, which is why I footnoted it. Our standard hours are the actual units we produced, 10,600, times the number of hours per unit that we planned to get to our 31,800. So that standard hours number is in that footnote, and that's how we get 31,800. We multiply the two together, and we get 489,720. Before we go any further, we can already see that what we planned on in total dollars is lower than what we actually ended up with in terms of hours and price. Now we have the column in the middle here. And you'll notice that in black I have standard hours because we used 32,000 as the hours in both cases. And in blue I have standard price because you'll notice that the standard price is used in both calculations. We multiply actual hours times standard price and we get a total in the middle. The reason that is done is to say, what if we assume actual hours worked and multiplied it by the standard price? Where would we end up then, which is sort of a middle figure? The reason that we have those three columns is to come up with our variances. So we have a rate variance, which means a variance because the price we paid for labor is different than what we planned, different than standard. And you'll notice it's the 480 in blue less the 492,800 in green, and it ends up being a negative number. Because we're looking at expenses, if actual is less than standard, that's favorable because we spent less money. It's favorable because we spent less money. So rate variance has to do with the fact that the actual hours are the same in both columns, but price is different. Here's actual price, here's standard price. That's a rate variance, difference in what the price you paid for labor, which means maybe you have to pay, you have the opportunity to pay less for labor because we're in a slow economy and people are willing to get paid less. The other variance comparison here is efficiency. And we'll see that if I click on the cell, 489,720 in green less, in blue, excuse me, less the 492,800 in blue less the green 489,720 gives us a positive number. That is unfavorable because it says in the far right column we planned on 489,720, that was our standard. But if we use standard price times our actual hours, we end up with a higher figure, so that is unfavorable. That means that our workers didn't work as efficiently as we expected them to. Maybe they were new, maybe they were poorly trained, somehow they were inefficient. We net the two variances together by adding them, and we end up with an overall variance that's favorable because with expenses you want a negative number, a lower number, and so overall we have a favorable variance. So that is a discussion of, we go back up to the top, labor rate and labor efficiency. Labor rate and labor efficiency. Let's go on to a next problem. Let's just talk about labor rate one more time to get that concept solidified. Sims Corporation had a favorable labor rate, direct labor efficiency variance for the period just ended. That means that their workers were more productive than they expected, and a favorable variance would mean a $6,000 savings. The actual rate was 50 cents more than the standard rate. That would be unfavorable. We paid 50 cents more per hour than we expected, maybe because we had to pay more to get more talented, capable employees. Then we get to the question. If the company's standard hours allowed for actual production, total 9,500, how many hours did the firm actually work? Now this is a different question because if I highlight the end of the sentence, we're being asked to figure out hours. We're being asked to figure out hours worked. Hours actually worked means we're being asked to figure out actual hours, and that's why I have plug figure next to that. So what we do is we figure out all the other numbers and then fill in the puzzle by plugging in this last because we have all the other information. Specifically, we know that we have an efficiency variance that's favorable of 6,000. So I put down here 6,000 as a favorable variance. That's the difference between this total and this total. So I know that this column that includes actual has to be 6,000 less than standard. Favorable variance. That's given. I know the standard rate was 12. That's given here. I know the actual rate was 50 cents higher, $12.50. That's given. Since I know both of these figures, I can multiply down. That figure's given, and that figure's given. And it says standard hours for actual production totaled 9,500. That's given. So I know this one, that rate, that rate, that rate. The only thing I don't know are these two numbers. In order to plug this total, since I don't know the 9,000 yet, in order to get this total number, I take the 114,000 and I subtract the efficiency variance because I know that the actual hours, the actual middle column is going to be 6,000 lower. So even though I don't know the 9,000, I know 12 and I know the 108. 114 less than 6,000 is 108. And now I can take the 108,000 divided by 12 and I can plug in the actual hours, 9,000, which allows me to finish this cell, this calculation, and this calculation, and I can finish the whole problem. Much of what you're going to be asked in these variance charts is going to be, if we give you some of the variances, some of the numbers, do you know the concept well enough so you can figure out the rest of the chart? That's what they're trying to do. Let's go back to material variance. Direct material quantity variance. We haven't talked about direct material yet, but it's the same type of discussion. You can pay more or less for material. That would be a price variance. You can pay more or less, you can use more or less of the material in your production. So if you're making Levi's blue jeans and you're using denim, you may use more or less denim in your production. That's a quantity variance. So we have a price variance and sometimes called usage, sometimes called quantity variance, and this one's quantity. Diana recently completed $56,000 of a product expected to consume 4 pounds of direct material per unit. So this many units times 4 pounds, that sounds like the standard amount that I'm going to use. Let's keep that in mind. The standard price of the direct material was $8.50 a pound. There's my standard price, $8.50. it says the cost is 1,881,000. That should say actual. Let me correct that. I'm copying and pasting this from an old student assignment for students, so sometimes I don't pick up all the numbers. If the firm purchased and consumed 228,000 pounds, so there's my actual quantity, 228,000 pounds. Now we finally get to the question. Direct material quantity variance would be figured as. In other words, how much more or less stuff did we use, let's say denim, than we planned on? How much more or less denim did we use than we planned on? Let's look at the chart. I'm going to expand the cell here to show. As I mentioned at the beginning, 56,000 units times 4 pounds of material per unit gets me 224,000. 56,000 times 4, 224,000. That is the number that goes in my standard quantity, and you'll see that I have that footnote here. 224,000. This number is given. We multiply them together to get 1,904,000. Standard price is in both columns in blue, $850. The 228,000 was given in the question. That was the actual that was given in the question. Multiply down 1,938,000. This number was actually given in the question. Now the one number that you're not given is actual price in red. We're given the actual quantity, 228,000. We're told the total actual cost, 1,881,000. We have to plug this figure, which is why I've written it in parentheses. Total cost divided by quantity used, quantity purchased, excuse me. $8.25. And I'll note one more thing on this question. You'll see on the far left I have actual quantity purchased. The description in the middle is for the same number, 228,000, but the title is actual quantity purchased and used. You may also see the term used or placed into production. Variance is the same as we saw with labor. Our standard, our actual quantity times standard in blue, 1,938,000 less standard quantity and price of 1,904,000 means we have an unfavorable variance because when we introduce actual quantity, we end up with a higher cost. As opposed to standard, it's unfavorable. However, when we look at actual quantity and price, it's 57,000 less than the middle column. That is a favorable variance. Blue minus green. If we added these two together, we'd see that in total there would be a favorable total variance since the 57,000 is more than the 34. Back to a price variance question. We talked about quantity over here. Let's talk about price. And remember that the price is the same as labor rate. Material price is the same concept as labor rate. How much did you pay for the materials as opposed to how much did you pay at an hourly rate for labor? Solo Corporation recently purchased 25,000 gallons of direct material, that's the actual quantity, at a price of $5.60. There's my actual price. Usage, which is another word for quantity, by the end of the period amounted to 23,000 gallons. That's actual quantity used in brown, which is different from what we purchased in the middle. Standard cost is $6 a gallon. The company believes in computing variances at the earliest possible point. And now, finally, you're being asked the question, what's the direct material price variance? You'll note in the slide that we haven't figured out, we haven't computed all the numbers on the right-hand side, which is okay because the question has to do with material price variance only, which means we only need the left-hand side of the chart for price variance. The right-hand side of the chart is quantity, and we don't need that to answer the question. The $25,000, that's what we actually purchased. The $5.60, that's what we actually paid. The standard cost $6 a gallon. We multiply down. Actual times standard, we multiply down. There's our actual times actual. And we see that we actually paid $140, but when we introduced standard price, we expected a higher standard price by 40 cents, $6 versus $5.60. So working toward the middle, our standard price would have been higher, so it's a favorable variance. Actual is less than standard by $10,000. We don't need the right-hand side of the chart, so don't panic if you set up this entire chart and you're only asked to answer information from part of the chart. You don't need what's on the right-hand side here. So don't panic when you see that. Continuing on, here's another one where I didn't include the language, but this is a labor and efficiency variance question. Again, let's talk about one that's in a little more detail, that requires a little more work. This calculation below is the one that requires a little more work. It says we've got standard hours times standard price, which is 8,000 times 10 to get the 80,000. We subtracted a favorable variance to get the middle calculation, which is 75,200. If we divide that by the standard price of 10, we can back into the actual hours figure. So what I have in blue in the heading is, how do I figure out actual hours if I'm not given the whole chart? I know the standard hours and rates. I know this total because the 80,000 with the favorable efficiency means that I subtract 4,800 to get this number. I know this number because that's the standard rate, so I'm able to back into the actual hours, which is a common way that the question is asked. I want to wrap up today talking about sales volume variance. This has to do with selling. If you're a salesman and you're out selling stuff, two things can happen. You can sell more or less stuff. The price of the stuff that you sell can also be different. So this is a sales volume that has to do with commission. Gordon Merchandising anticipated, that should be a red flag that they're talking about a standard, anticipated selling 27,000 units of a product, that's our budgeted sales volume, and paying a commission of $6 a unit. There's our budgeted sales commission. Actual sales and sales commissions totaled $27,500. And our total in dollars is $171,400. That was their budget for performance. And then it goes on to say that the firm uses a flexible budget, which I mentioned at the very beginning. The flexible budget, which is an actual versus a standard, is why we have variances in the first place. So that's why we mention it right here. If the company used a flexible budget, Gordon would report a cost variance of, and now we fill in the rest of the chart. So far we've talked about everything except this actual sales commission number. And you'll see that if I take the total dollar amount I was given, the $171,400, and I divide it by the actual sales volume, I get an actual sales commission of $623. We can fill in the same types of variances. We have a price variance because the commission price we paid was different. The actual commission we paid was different from what we planned. Our commissions paid was higher, so that's an unfavorable variance because as a company we're paying more in commissions. Actual was more than standard. Volume variance, we didn't sell as much stuff as we thought. We actually sold more stuff than we thought we would. which means that we pay a different total commission. We paid more commission than we planned, which is why it's an unfavorable variance. So you can see the numbers get greater as we go from budgeted or standard over to actual. That's unfavorable. We sold more than we thought. This is unfavorable. We paid a higher commission than we thought. So you can see that we have a total variance that would be 9,400 unfavorable due to a higher commission per unit and higher sales than we expected. That is the end of our first section in Advanced Cost Accounting Part 1, Labor, Material, and Sales Variance. Thanks very much for watching, and we'll see you on the next section.